Methods to explain the cross-section of expected returns of assets is a fundamental and important problem in risk management of financial assets. Conventional approaches to constructing the said factors typically involve sorting the stocks based on the risk matrix. This is inherently nonlinear and at times could be unstable due to sparsity in stock groupings. In this particular project, deep learning for asset pricing using characteristic sorted factor models, we present a methodology to imagine the factor construction process as a deep learning problem wherein the inputs are the raw characteristics, the intermediate factors are the learned risk factors, and the outputs are model implied returns. We augment the Pharma French three-factor model using the latent factors that were learned using deep learning. Further, the sorting mechanism has been replicated using nonlinear activations. The novelty of the paper by Feng et al. Has been to come up with a unified framework to learn these latent factors from raw characteristics of the firms. Mehdi?
Our dataset consists of historical US data from 1990 to 2020. To focus on significant contributors, we selected 1,000 most liquid stocks, excluding those with insufficient or mission data. The data include price and volume, from which we derive 15 technical factors. It also includes fundamental data, from which we derive 35 fundamental factors. To ensure consistency and the model stability, we addressed missing values with zero imputation and normalized all features to range -1 to 1. This pre-processing step creates a robust foundation for our modeling and analysis. Over to Manish.
Our architecture consists of three deep networks which are trained simultaneously. The first one consists of a four-layered deep characteristic network, and then the other two are the beta networks for the deep characteristics and the benchmark factors. Our loss function consists of four terms. The first term is the loss, which minimizes the model produced returns against the real returns, which is the main driving loss. And then the other three terms are the second term is the average value of the cross sectional alpha to zero. The third term regularizes the weight matrix, and the last term regularizes the betas. Our main evaluation metric is R square, which explains the fraction of variance explained by all the factors used versus the benchmark. Our parameters were chosen by extensive grid search, and we chose a stable region. Same for the meta parameters. In terms of results, we see that our network trains quite fast. Within 30 to 50 epochs, we've reached the minimum of the validation set. We chose early stopping to choose our final model. In terms of results, we see that our R square doubles by adding two extra deep factors, which is quite a good result for such a simple model. We also see that the two factors which we identified were, one was a technology factor and the second resembled a mean reversion and short-term momentum factor. Over to Gautam.
So, about the future importance, in financial asset management, white box model are preferred over black box model due to their transparency. We use sensitivity of the learned D factors to the input characteristics as a proxy of feature importance. In the last epoch, we find that characteristics such as leverage, which is defined as equity to debt ratio, book value per share, and book to market, both of which are used to assess the company's value, were significantly able to impact the deep characteristics. Mehdi?
In our experiments, we compared L1, L2, and Huber loss functions. The results suggested that Huber loss may slightly improve the generalization compared to L1 and L2, as we can see in three graphs below. As a future work, we plan to leverage the model output to construct optimized portfolio and evaluate latent factors' impact on predictability through Sharpe ratios and hedging effectiveness. Thank you.